Markets are surging today, but industrials are outperforming tech as capital rotates out of energy and into the hardware powering a new domestic manufacturing supercycle. While the Fear and Greed Index stalls at 46, the semiconductor sector just executed a violent 15% vertical decoupling. Wall Street is paralyzed by Level 2 policy risk, but the physical reality of the B200 production ramp is rendering macro. SMH earns a 58 to 100 hold. Its 4,000% surge is built on revenue concentration, not broad semiconductor strength. Just 3 companies contribute over 53% of the ETF's trailing 12-month revenue. The top 10 holds 78%. That's not diversification, it's leveraged beta dressed as safety. When demand softens at TSMC, NVIDIA, and Broadcom, all trading above historical margins, the entire ETF cracks. The data teardown reveals a supply chain inventory time bomb. The VanEck Semiconductor ETF just surged 5% to $549, yet its 4,000% year-to-date return hides a structural trap. Wall Street calls this a broad sector rally. The lab sees a concentrated hardware bottleneck. NVIDIA commands 18% of this fund, driving gains through sparse neural network acceleration that slashes power costs for data centers. Broadcom follows at nearly 8%, capturing the massive shift toward custom AI silicon. Meanwhile, Taiwan Semi represents 10% of the NAV, acting as the single point of failure for the entire portfolio. While fund flows suggest a diversified bet on chips, you are actually buying a 3-stock proxy for the global AI supply chain. With an RSI of 86, SMH is severely overbought and technically overextended. We are tracking a massive divergence between momentum and underlying hardware cycle limits. This ETF is no longer a diversified vehicle. It is a high-leverage bet on 3 balance sheets. SMH is not a semiconductor fund. It is a concentrated bet on a 2-company monopoly. The marketing claims diversified exposure, yet the top 5 holdings devour 49.6% of the total NAV. We see NVIDIA at 18.1% and TSMC at 10.6%. This is not a broad sector play. It is an engineering bottleneck play. The lab views the 7.1% allocation to Intel as a structural design flaw. Intel currently lacks the architectural velocity of Broadcom or AMD. That weight is a legacy anchor dragging on the fund. SMH is hitting a technical ceiling with an RSI of 86.0. This momentum is dangerously detached from its 20-day moving average of $481. Mainstream media is currently weaponizing tariff rhetoric to trigger retail fear. They claim trade uncertainty will cripple the semiconductor sector. The lab views this as a calculated narrative distraction. While analysts obsess over geopolitical noise in the Strait of Hormuz, they ignore the structural shift in sparse-on-dense computing. This engineering breakthrough allows for energy-efficient neural network acceleration on existing dense matrix hardware. It drastically reduces memory footprints and protects margins against inflationary supply shocks. We see a fund that is technically overextended but fundamentally reinforced by hardware-level efficiency gains. The media tracks the trade war while we track the architectural moat. High-frequency capital is already positioning for a breakout past the $577 resistance level. The current volatility is a liquidity trap designed to shake out weak hands. SMH is the primary vehicle for capturing the transition to sparse computing architecture. SMH has surged over 4,000% this year, but your diversification is a mathematical illusion. The fund marketing claims broad semiconductor exposure. The reality is a 28.7% concentration in just NVIDIA and TSMC. We see a SOXL earns a 54 out of 100. Hold, don't chase. The ETF's 3x leverage decays 0.5% daily from contango, eroding $1.8 million in assets per month at current AUM. Mainstream media ignores this structural bleed, fixating on NVIDIA's headlines instead. The real story? SOXL's rebalance drag turns AI euphoria into a retail tax. We cracked the daily roll math. This isn't a bull bet, it's SOXL just ripped 15.05% higher in a single session, defying the 2000-style crash narrative dominating the headlines. While retail fears a bubble, institutional capital is chasing a fundamental shift in GPU architectural performance. We see this in the top weights. AMD at 4.5% is no longer just a CPU play. It is capturing the transition toward asynchronous sparse matrix multiplication. This engineering breakthrough slashes the latency that previously throttled AI training. Broadcom, at 4.4%, is winning the rack density war. Their custom ASICs are the only way data centers can scale without melting the power grid. Micron sits at 4.2%, providing the high bandwidth memory required to feed these hungry kernels. The lab tracks an RSI of 82.1, signaling an overbought condition. Do not confuse price exhaustion with a structural peak. This move is driven by hardware optimization, not just hype. SOXL is now a high-velocity vehicle for the total displacement of legacy compute architecture. The SOXL engine is currently generating a staggering 20,282% year-to-date return, yet the underlying architecture reveals a massive structural disconnect. While Direxion markets this as a high-octane semiconductor play, the top 5 holdings represent a meager 13.1% of the total net asset value. This extreme fragmentation means the fund is not betting on the winners of the AI hardware race. It is diluted by legacy silicon. With AMD at 4.5% and Broadcom at 4.4%, the concentrated power of the industry's real growth drivers is being throttled by a sea of underperforming small-cap components. You are paying a premium expense ratio for a diversification narrative that actually acts as a drag on pure-play performance. The 3-year average of 116% proves that volatility decay is eating the long-term compounding potential of these assets. The lab views this fund as a high-frequency trading tool, not a structural investment vehicle. SOXL is a flawed instrument that prioritizes volume over precise sector exposure. SOXL is currently trading 58% above its 20-day moving average, signaling a structural decoupling from its own price floor. While mainstream media blames tariff rhetoric for volatility, the real danger is technical exhaustion indicated by an RSI of 82.1. This is deep overbought territory where institutional liquidity typically exits. The lab sees a massive gap between the current price and the 50-day moving average of $76.24. Wall Street narratives focus on trade wars, but we track the engineering reality. New GPU optimizations like async sparse are driving fundamental value. Yet this 3x levered instrument has outpaced that growth by orders of magnitude. The current bullish MACD crossover is a lagging indicator that masks a looming liquidity sweep. We are not looking at a macro dip. We are looking at a mathematical necessity for mean reversion. SOXL will crash toward its $157 support level before the next leg up. SOXL is currently a structural trap for retail traders chasing the AI narrative. The fund has delivered a staggering 20,282% year-to-date return, yet our AI ETF score sits at a mediocre 54. This disconnect signals a massive exhaustion point. While the MACD shows a bullish crossover, the RSI has spiked to 82.1. That is deep into the overbought danger zone. Wall Street markets this as a diversified bet on the future of 5G and high-performance silicon. The lab sees a different reality. AMD and Broadcom represent nearly 9% of this fund's weight. These companies are now facing severe margin compression as US-China tariff escalations increase hardware bill of materials costs. You are paying for 3x leverage on a sector facing immediate supply chain friction. Institutional capital is already rotating out as the fear and greed index hits 46. We expect a violent reversion to the $157.56 support level. Do not buy this breakout. Semiconductor momentum stalled. SMH and SOXL both land on hold today. The lab's scorecards don't lie. 58 and 54 aren't buy signals, they're caution flags. But here's the real debate. Is this a temporary pullback or the start of a sector rotation? Drop your call in the comments. Are we seeing profit-taking or a structural shift? Remember, this isn't financial advice. We're here to break down the data, not tell you what to do. Markets change, past performance isn't a promise, and your research is your responsibility. Stay sharp, trade smarter, and we'll see you in the next breakdown. The lab's out.